In the past year, the world's largest asset manager quietly shifted more than $2 trillion outside the United States. There were no breaking news alerts, no dramatic headlines, no emergency press conferences. Most people never noticed. But for anyone who pays attention to how global money really moves, this was one of the most important financial developments in recent years, because when an institution that manages trillions of dollars changes direction, it is never random. It is calculated, it is researched, and it is intentional. I'm talking about BlackRock. With more than $10 trillion under management, BlackRock influences everything from stock markets to pension funds to government bonds. When they adjust their strategy, it affects investors all over the world, whether they realize it or not. And recently, BlackRock has been steadily increasing its exposure outside the United States while reducing its reliance on domestic assets. Not in one dramatic move, not in one announcement, but through a series of quiet, systematic reallocations. So the real question is not whether this happened. It did. The real question is why. To understand that, we need to step back and look at the environment that large institutions are operating in right now, because on the surface, the U.S. economy still looks strong. Stock markets remain near historic levels. Major technology companies continue to dominate headlines. Corporate profits are still positive in many sectors. From a distance, everything appears stable. But when you look closer, the picture becomes more complicated. Over the past several years, government debt has risen sharply. Interest rates have moved higher after a long period of easy money. Global trade patterns are shifting, geopolitical tensions are increasing, and financial markets are becoming more sensitive to economic data than they were before. For individual investors, these changes may feel abstract, but for institutions managing trillions of dollars, they are central to every decision. BlackRock does not think in terms of months. They think in terms of decades. They analyze demographic trends. They study political risks. They monitor capital flows. They stress test portfolios under multiple economic scenarios. And when they make changes, those changes reflect long-term expectations, not short-term headlines. Over the past year, BlackRock has been gradually increasing allocations to international infrastructure, emerging markets, global real estate, and non-U.S. bonds, while becoming more selective with American assets. This does not mean they are abandoning the United States. It means they are reducing concentration. They are spreading risk. They are preparing for a more complex global environment. And this is something experienced investors do before uncertainty becomes obvious to everyone else. Another important factor is the changing role of the U.S. dollar. For decades, the dollar has been the backbone of global finance. Most trade, most commodities, most international contracts, all priced in dollars. That system created enormous advantages for the American economy. But today, more countries are experimenting with alternative settlement systems. More trade is being conducted in local currencies. More central banks are diversifying their reserves. Again, this is not a sudden collapse. It is a gradual evolution. But gradual changes matter when you manage trillions. BlackRock is watching these trends carefully. They are positioning portfolios for a world where capital flows may be more fragmented than in the past, where regional growth matters more, where political risk matters more, where currency exposure matters more. At the same time, higher interest rates have changed the math of investing. For years, money was cheap. Borrowing was easy. Risk-taking was rewarded. Now capital has a cost again. Returns must justify risk. Leverage is less attractive. Cash flows matter more, and that naturally shifts how large portfolios are structured. In this environment, concentrating too heavily in one country, one market, or one asset class becomes dangerous. Diversification becomes a form of insurance. That is exactly what BlackRock is doing. They are not reacting to fear. They are responding to data. They are adapting to structural changes in the global economy, and they are doing it quietly before it becomes obvious. So when people talk about BlackRock moving trillions out of America, it should not be interpreted as a vote of no confidence. It should be understood as strategic risk management. It is about balance. It is about flexibility. It is about preparing for multiple possible futures instead of betting everything on one outcome. And once you understand that, the next question becomes even more important. What trends are driving this shift? What signals are large institutions responding to? And what does this mean for the rest of us? To answer that, we need to look at how global capital is moving right now and why major investors are becoming more selective than they've been in years. To understand why BlackRock and other major institutions are becoming more selective, we need to look at how global capital is moving right now, because money always moves before headlines change. Long before economic slowdowns are officially announced, before policy shifts are debated, before markets react, large investors begin adjusting their positions quietly, and that is exactly what we are seeing today. One of the most important trends is diversification across regions. For decades, the United States was the default destination for global capital. It offered deep markets, political stability, strong legal systems, and the world's reserve currency. For international investors, U.S. assets were considered the safest and most reliable option. That is still largely true, but the dominance is no longer absolute. In recent years, more investment has been flowing into Europe, parts of Asia, and selected emerging markets, not because these regions are suddenly risk-free, but because they offer different growth cycles, different policy environments, and different sources of return. For institutions managing trillions, reducing dependence on a single economy is simply prudent. Another major factor is infrastructure investment. Across the world, governments are spending heavily on transportation, energy, digital networks, and climate-related projects. These investments generate long-term, stable cash flows that appeal to large funds. BlackRock has increased its exposure to toll roads, ports, power grids, data centers, and renewable energy systems outside the U.S. These assets are less sensitive to short-term market swings. They benefit from long-term contracts. They are often supported by government policy, and they tend to perform well during periods of economic transition. That makes them attractive when uncertainty rises. Currency exposure is another key consideration. When portfolios are heavily concentrated in one currency, they become vulnerable to policy shifts, inflation, and interest rate changes. Over the past decade, the dollar has been strong, but strength creates risk. If conditions change, concentrated exposure becomes a weakness. By increasing international investments, institutions naturally diversify currency risk. They gain exposure to euros, yen, yuan, and other currencies. This does not mean betting against the dollar. It means building resilience. Interest rates have also reshaped investment strategy. After years of near-zero rates, borrowing costs are now significantly higher. This affects everything. Governments face higher debt servicing costs. Companies see margins pressured. Real estate financing becomes more expensive. Highly leveraged business models become less attractive. In this environment, investors favor companies and projects with strong balance sheets and predictable cash flows. Speculative growth becomes less appealing. Stable returns become more valuable. BlackRock's recent allocations reflect this shift. More emphasis on income-producing assets. More focus on quality. Less tolerance for excessive risk. Another important trend is demographic change. In many developed countries, populations are aging. Workforces are growing more slowly. Healthcare costs are rising. Pension systems face pressure. These factors influence long-term growth potential. They also affect where capital flows. Some regions offer younger populations and faster urbanization. Others offer technological specialization or manufacturing advantages. Large institutions analyze these patterns in detail and position accordingly. They do not chase short-term excitement. They follow long-term fundamentals. Geopolitical risk is also playing a larger role than it did in the past. Trade tensions, sanctions, supply chain disruptions, regional conflicts, all of these increase uncertainty. They affect energy prices, they affect commodity markets, they affect manufacturing decisions. Investors cannot ignore these risks, so they spread exposure across multiple regions and sectors. They avoid over-reliance on any single political system. They prepare for volatility. Another signal comes from corporate behavior. Multinational companies are also diversifying operations. Manufacturing is being distributed across multiple countries. Supply chains are being redesigned. Strategic industries are being reshored or nearshored. This reshaping of global production affects investment flows. Capital follows production. When factories, data centers, and logistics hubs move, investment follows. BlackRock is aligning portfolios with these structural changes. Technology investment is also evolving. While artificial intelligence and digital platforms remain important, spending is becoming more disciplined. Investors are asking harder questions about profitability, about timelines, about return on capital. The era of unlimited funding for unproven ideas is fading. That encourages more selective allocation, more focus on sustainable business models, less tolerance for speculative hype. When you put all of this together, a clear pattern emerges. Global capital is becoming more cautious, more diversified, more selective, more focused on resilience than on maximum growth. This is not a retreat from opportunity. It is an adaptation to a more complex world. BlackRock's moves reflect this reality. They are positioning for slower but more balanced growth, for regional diversification, for higher interest rate environments, for increased political and economic uncertainty. And this behavior is not limited to one firm. Pension funds, sovereign wealth funds, insurance companies, endowments, they are all making similar adjustments, quietly, gradually, without headlines, because in institutional investing, the goal is not to predict crises. It is to survive them. It is to perform across cycles. It is to protect capital while still seeking opportunity. And that mindset explains why trillions are being reallocated today, not out of panic, out of preparation. Which brings us to the most important question. What does this shift mean for individual investors? And how can you apply these lessons to your own financial decisions? Now let's talk about what all of this means for you, because understanding what BlackRock and other major institutions are doing only matters if you know how to apply it to your own financial life. The first thing to understand is that most individual investors are far more concentrated than they realize. Through retirement accounts, index funds, and mutual funds, many people are heavily exposed to the same U.S. companies in the same sectors. That can work very well during strong market cycles, but it also increases risk when conditions change. What BlackRock's strategy highlights is the importance of balance, not abandoning growth, not avoiding opportunity, but reducing dependence on any single market, theme, or trend. Diversification is not about lowering returns, it is about protecting long-term stability. Another key lesson is flexibility. Large institutions keep room to adjust. They avoid locking all their money into a liquid or highly leveraged positions. They maintain access to cash and liquid assets so they can respond when opportunities or risks appear. For individual investors, this means avoiding overextension and keeping enough liquidity to make thoughtful decisions rather than emotional ones. It is also important to focus on quality. In uncertain environments, strong businesses with healthy balance sheets, reliable cash flow, and proven management tend to outperform speculative investments. Chasing hype may feel exciting, but it often leads to disappointment over time. At the same time, patience matters. BlackRock is not making these changes overnight. They are adjusting gradually based on long-term analysis. That is a reminder that successful investing is not about reacting to every headline. It is about following a consistent plan and adapting when fundamentals change. You do not need to copy any institution's portfolio. Their goals, resources, and risks are different from yours, but you can adopt their mindset. Think in years, not weeks. Manage risk before chasing returns. Prepare for multiple outcomes instead of betting on one. Most importantly, stay informed. Learn how markets work. Understand economic cycles. Pay attention to structural trends rather than short-term noise. The more you understand, the less likely you are to be driven by fear or excitement. BlackRock's recent moves are not a warning of disaster. They are a signal of careful planning in a changing world. They show how experienced investors respond when the environment becomes more complex. If you approach your own finances with the same discipline, balance, and long-term perspective, you put yourself in a much stronger position no matter what the market does next. Thanks for watching. If you found this analysis useful, make sure to like, subscribe, and share it with someone who wants to understand the market, not just react to it. I'll see you in the next video.